Gary Segal from Oceana Funds. Welcome to the Alternative Symposium.
Thank you very much.
Who is Oceana and how did the group come about?
So Oceana Funds is a fund management platform. We've got two primary strategies. We've got a property equity strategy and the flagship strategy, which we've been talking about today at the conference, Oceana Australia Fixed Income Trust. It was funded by David Lewis 8 years ago. He's got a 20-year background in securitization, structured finance. It's an alternative private credit strategy. Essentially, we're a non-bank lender lending to a highly diversified portfolio of borrowers across different sectors. David, or what kind of kick-started the business was David, identified a gap in the market, which still exists today. Essentially, our focus is on the SME and MME sectors, and there's huge credit demand from those sectors in Australia. And there was and continues to be an access issue in terms of bank funding. So that is something that we focused on and which helped kickstart the business, which started in trade and supply finance.
Did you ever expect such a massive tailwind in non-bank lending when the business was started?
It's difficult to predict. So the fund has kind of exceeded our expectations to an extent. I mean, at one point, if you asked what our goals were, we would have been happy when it hit 50 million. But it turns out that there's been demand on both sides. There's been an increasing pipeline of borrowers in those segments that we could lend to, and an increasing appetite in private investors, particularly offshore in the US, that have found our product appealing.
And you work in some of the more niche sub-sectors of private credit. Could you expand what that universe of investment looks like?
Sure. So our fund is approximately 850 million at the moment. About 80% is trade and debtor finance, concentrated in defensive industries like pharmaceutical and healthcare, food and agriculture, logistics, wholesale trade. We also have a growing arm, a corporate lending arm of about 175 million of our 850, which again focuses on mid-market companies that are EBITDA positive, also in defensive industries like pharmaceuticals, healthcare, food and agriculture.
What are some of the most common misconceptions about an investment in trade finance?
So I think if you're talking to someone who's unfamiliar with that space, they may see it as particularly risky and something that is susceptible to high default rates or high arrears rates. But as demonstrated in our fund since inception, which has an average annual arrears rate of 1.7% over 8 years, when you do it right in conjunction with a strong underwriting policy and defensive portfolio construction, which is the way that we've set it up, you can actually achieve very low default rates and high risk-adjusted returns. A second misconception is people may think about trade and debtor finance as a form of finance of last resort almost, but people don't understand that payables and receivables is the nature of any business, and it's a useful working capital tool that borrowers in our space can utilize to strengthen their stakeholder relationships and also improve their working capital.
And they tend to be a revolving source of funding too, don't they?
Yeah, absolutely. It's not necessarily seen as growth capital, whereas a term loan or a line of credit that they outgrow. The borrowers that we've had for a very long time, and as they grow, their payables and their receivables grow, and so do their exposures.
How important is diversification within the OFIT strategy?
Look, diversification is important to any investor, as we all know. In a recessionary environment, it's paramount, and that's the approach that we take in the OFIT strategy. I think when you have an investment that's overly concentrated in a particular industry or it's overweight a particular borrower, that's something that we typically try and avoid, and we've structured the fund in a way that avoids that. So if you look at the way that we structure our fund, it's 850 million, but it's comprised of 7,000 borrowers. The average loan size is 75,000. The average tenor is 93 days. On top of that, we also have caps on industries that we invest in. So we can't be too concentrated in any one industry, and we cannot be too concentrated to any one borrower or borrower group. And just to, it's kind of evidence that two key metrics which I want to point out is our returns. So in the 7 years that we've been running, we've averaged 14% per annum on our underlying assets. And as I mentioned before as well, our arrears rates are low. We've got a strong underwriting policy, and our arrears rates are averaged 1.7% per annum since inception.
And what implications do you see from a more divergent economic environment on default rates or lending more generally?
Yeah, look, it's difficult to tell. We've had a pretty resilient performance in our underlying book, given our portfolio construction and our underwriting policy. So going from 2014, when we actually started lending before the fund launched, our arrears have hovered around the 1.7 to 1.8% annual mark. One of our true kind of litmus tests was during COVID, where our returns remained stable and our arrears remain stable. And I think you can attribute that to the nature of trade and receivables financing, which have kind of an inbuilt resilience to recessionary pressures. That's because we don't actually provide cash ever to a borrower. We only ever fund actual payables and actual receivables. And for those to be, for there to be a payable or receivable, a business has to be operating and performing and actually have business to write. So the nature of these underlying assets has proved to be quite resilient in our fund strategy.
What would you suggest is the key reason advisors should be considering allocating to the sector today?
Probably a few. I'd say, and I've touched on a few of these, but returns. So as I mentioned, 14% since inception. Supplier finance and receivables finance, you can generate relatively strong risk-adjusted returns ranging from 12 to 24%. The default rates we've already touched on. Liquidity is an important one for investors. Our underlying loan pool has an average tenor of 93 days. Our average investor has an investment ranging from 3 to 5 years. So there's never really a duration mismatch, and that's why we can offer 60-day liquidity for a credit product, which is actually quite unique. Diversification is another key one, which I've already touched on. And a very important credit enhancement, which gives investors a high level of confidence, is the nature of these assets are eligible for trade credit insurance. So we've got policies with QBE and Allianz, which we've maintained since inception, and covers things like borrower defaults and insolvency. So we don't rely on it in place of good underwriting, but it is an important credit enhancement tool unique to the sector, which gives investors added comfort.
And how important is your size and scale for deal flow these days?
I'd say, looking at our trade and supplier finance book, we're seeing growth of 5 to 7 million per month. Yeah. Our corporate lending book, which I mentioned, is 175 million over the 850. We turn away 90% of the deals. So there's incredibly high deal flow. So our fund is growing 100 million year on year, and we don't have a problem deploying that. There's demand, and the businesses that we have relationships with in the sectors that we are focused on are demonstrating continued growth and appetite for our product.
Gary Segal, thank you.
Thank you very much.